Right, class, welcome to continue our discussion of long-term assets. We're going to look at depreciation and disposal in terms of how we record that issue. Well, we're not going to spend too much time on depreciation because that really is what essentially nothing more than what you learn in Accounting 101. There is, in the codification, in the standards, there is no specific method for calculating depreciation given. So you should have learned the double declining balance, straight line, maybe units of production, but none of those are specified or even allowed necessarily in the accounting rules. Only thing that they say is that any method you use must be reasonable and rational. So there really is very little guidance on that, despite how much we teach in accounting in earlier classes. So we're not going to expand on that. Just remember a couple of things that if you're going to do, if you're calculating depreciation, you need to make sure you understand if it's a part of a year, that you only do part of the year depreciation. If it's a half-year convention, that you do a half year on every new asset and every old asset that's being disposed of. More to the point, and things that usually cause us more trouble, disposal of assets. So remember that when we dispose of assets, especially those that have depreciation involved, we need to credit the asset being disposed of at its original cost. We need to debit the accumulated depreciation that goes along with that. We would then debit cash or other assets we receive in return for that long-term asset. And then the difference to make our journal entry balance is either a gain or a loss. And that's how we do our journal entry. Now, some complicating factors about that is when there is a trade-in, all right? Trade-in means that we have, instead of just selling an asset outright, we take it in, we trade the old one in and get a new one. In this situation, when there is a trade-in, when you receive another asset instead of cash, you're always going to recognize losses, meaning if the calculation, as we described it earlier, ends up with a loss, you're going to recognize that. So that's straightforward. That's an easy concept. However, if there is a gain in certain situations, we are not going to record that gain. We're going to defer it or postpone it if there's not commercial substance. So how do we determine if there's not commercial substance? Well, some guidelines. If you receive less than 25% of the value of the asset in cash, then you are basically looking at there's not commercial substance. If it is more than that, then it does have commercial substance, and you're going to recognize the percentage of the gain that is demonstrated by the percentage of the cash received. Okay? So this, if you're giving up cash, now most of the time, a trade-in, you're actually going to be paying cash. All right? If you're paying cash, then obviously the amount of cash received is less than 25% of the value. So you're not going to have commercial substance. So that is the case in most trade-ins because most of the time you take your trade-in in, and what they do is they just knock off part of the value. They just add the credit towards your new asset. And so really nothing has changed. You go down to the dealer with an old asset, come back with a new asset, but as far as the earning process for that asset is not complete. And so there would be no gain on there for the most part. If there's a loss, of course, we recognize it because we use that conservatism principle, and we recognize losses, but we defer gains in certain circumstances, and this is one of them that we need to kind of chalk up as remember that when that happens, we're not going to recognize that gain. Now, also in this same vein, as we have assets, we are required under U.S. GAAP to look at them for possible impairment. And impairment is basically this same concept of depreciation in that depreciation is using up the asset over time. Asset impairment is when the value or the usefulness of the asset drops substantially, not just because of normal wear and tear, but because of some change in the usefulness of the asset. It could be because of some kind of meteorite hit that, or something as a kind of an extreme example. There was a fire, flood, or there could be some change in the use of the asset such that it's not as valuable. A particular area of the country becomes particularly depressed, and therefore buildings there drop in value substantially, and the ability for us to use it for what we're using it goes down. So some rules to remember about this. First of all, property, plant, and equipment, tangible assets, have to be evaluated for impairment only if there's a change in their use. So we get a little bit of a break here. We do not have to check PP&E every year. We just have to check and see that we're using the asset in the way that it was always intended. So if we've bought a desk and we are still using that desk, we do not have to evaluate it for impairment each year. We just have to say, okay, are we still using it? If the time comes that we change the use, and that could be that we abandon it or stop using it or put it off in a storage unit or something, any of those would necessitate a check for impairment. But as long as it's being used, we don't have to, normal way, we don't have to worry about it. Okay? That also applies to amortizable intangibles. Those are intangible assets that actually get used up over time. They have a specific useful life, like a patent. That also would be tested for impairment when the use changes or our overall business changes such that we can't use that asset in the same way as we were. Now, there are non-amortizable intangibles. Those have no useful life, no set useful life, I should say. They have to be tested annually. So that's be like, for instance, a trademark is not typically amortizable because it has no finite useful life. Trademark is forever. So we'd have to look at that concept on an annual basis and see if it was impaired. So your standard or the number of times you have to check it is higher for non-amortizable intangibles. The biggest one of those is typically what we refer to as goodwill. That is classified as a non-amortizable intangible, so it must be tested for impairment every year. So how do we test these, any of these assets? Say that the use has changed or anything. That the test, once we determine that we have to do a test, is done the same way for all of these assets, except for, as we'll see in the next slide, note receivable. First of all, there's a test for recoverability. So we compare the carrying cost. Now, carrying cost is the cost of the asset originally minus any accumulated depreciation. So that you have to consider the depreciation that's already been recorded. And you compare that to the undiscounted future cash flows. That's how much money this asset's going to make us in the future. This, by necessity, is an estimate. It is future cash flows. But notice, we're not doing a present value calculation yet. It is simply add up the future cash flows and see if it is more than the carrying cost. If it is more than the carrying cost, then this is not impaired. We are going to recover all of the costs, and we're good to go. Document our test, and we're on our way. We don't have to make any journal entries. If the undiscounted cash flows are less than the carrying cost, then we have an impairment. So the first step is a test just to see if it's impaired. Once we have determined that it is impaired, the impairment loss is measuring by comparing our fair value to the carrying cost. Now we have to calculate fair value. Chances are our fair value is going to be determined by applying present value of future cash flows, similar to last week. So we'll take the cash flows from this asset, maybe we rent it out instead of using it. Those future cash flows will be now calculated as a present value. And the amount of that present value of those future cash flows is going to be lower than the carrying cost. It'll have to be because the asset is impaired. And we're going to adjust to that fair value by reducing the amount of the asset we have recorded down to its present value of the future cash flows, or its fair value. So we'll use that, our tools, our present value calculations, in order to determine the fair value and then record a loss. Credit the asset and debit loss on the income statement. It's going to reduce our net income and so forth.